Welcome to China Gateway 360, connecting global businesses with China through insights, opportunities, and trends. Today, we're cutting straight to a major shift for foreign companies, the PBOC's brand new loan pilot in Hainan province that launched in July 2026, and exactly what it means for your bottom line.
Here is our roadmap for today. We'll be covering 1. The Hainan pilot, 2. LPR versus DR007, 3. The financial impact, and 4. Strategic steps.
All right, Section 1, the Hainan loan pilot.
So, for an entire decade, RMB borrowing costs were tethered to just a single benchmark. But as of this July 2026 pilot program, bank loans are now being priced against the DR007 money market rate instead. Now, to put into perspective why this is such a big deal, foreign invested enterprises currently hold approximately 4.2 trillion RMB in corporate loans in China. That is a massive amount of debt. So any shift in how those loans are priced is absolutely a critical development for your business.
Moving on to Section 2, LPR versus DR007 explained.
Let's break this down. On the left side, you've got the traditional LPR. This is an administered rate, set monthly, and honestly, it's highly rigid. It only moved about 35 basis points in all of 2025, even with some pretty deep policy cuts from the PBOC. But on the right, we have the DR007. This is the 7-day interbank repurchase rate. It's dynamic, it updates daily, and it actually reflects real on-the-ground market conditions. Just to give you an idea, back in June 2026, the LPR was sitting at 3.10%, while the DR007 averaged a much lower 1.85%.
And this isn't just some sudden, out-of-the-blue experiment. It's actually the result of a very deliberate infrastructure buildup by the State Council to liberalize interest rates. It all started with a policy target shift back in 2024, followed by the launch of a new DR-linked swap market in June 2026, and all of that culminated in the Hainan pilot.
Section 3. The financial impact. If you're managing debt in China, this policy right here is going to directly impact your margins. The absolute crucial number you need to remember is 125. That is the 125 basis point gap between the 1-year LPR and the average DR007 back in June 2026. Basically, in a fully DR-linked lending environment, that number represents the potential reduction in your benchmark borrowing costs, and that's before your bank even adds its credit spread.
China Gateway. Gateway.
Your gateway to business in China.
Let's translate those basis points into actual, concrete corporate savings. Say you have 100 million RMB working capital facility. Shifting from the old LPR-based cost over to a DR007-linked cost could literally save your company anywhere from 500,000 to 800,000 RMB every single year in interest. For well-rated foreign borrowers, this is a truly significant upgrade.
Which brings us to Section 4, Strategic Steps for Businesses.
Look, this pilot's clearly signaling a multi-year shift that's eventually going to affect every single foreign company holding RMB-denominated debt. So here are 5 pragmatic actions you can take right now. First up, review your existing loan agreements for any alternative benchmark clauses. Second, talk to your banks. Ask them about DR-linked products. It helps signal market demand. Third, actively model what this impact looks like on your cost of capital. Fourth, if you're expanding or maybe refinancing, you might want to consider setting up a Hainan subsidiary for first-mover access. And finally, number 5, monitor that new swap market. It could become a really great hedging tool for your floating rate debt down the line.
So we have to ask, is your RMB-denominated debt ready for the DR7 shift? That's all for this China Gateway 360. Like and comment to receive materials from us. Thanks for watching, and we'll see you next time.